says not yet. Hey, good morning, everyone. Episode 3 of The Loans You Know. I like that, Jennifer. You just quipped that out a second ago. Mark, good
Yep.
morning. How are you?
Good morning from
I'm
Grandma.
You just came in from the gym. I've got my Tennessee shirt on again because Vols are playing Mississippi State tomorrow night. It'll be fun on national TV.
Yeah,
Jennifer,
I've got
who
my
did Ohio
Remember Every
State?
Deployed.
Say again?
Yeah.
I've got my Remember Every Deployed shirt on.
Oh, I love that.
Awesome.
Who
Very
your
good.
Buckeyes? Who do our Buckeyes play tomorrow?
I want to say it's Washington, but I might be mistaken.
Maybe
I've
we
had
both
head
have a
cold
week
all
off.
We had a week off. I've had a head cold all week, and I just talked to someone. He's like, it might be something more serious. I grew up, you don't go to the doctor unless you're going to the hospital. And so this might be actually one of the times where I go to the doctor and get like antibiotic.
Oh gosh, I know you're not feeling good if that's the case.
No, I sound like God knows what. And everybody gets to see, because thank God I'm not a super vain person, makeup free Jen today.
Uh-oh.
Uh-oh.
So.
Well, I'm in from doing my walk and exercising, so I'm rolling with it. And it's sunny out in Texas today. We're supposed to be in the mid 80s, and what great weather. So there you go.
We've been rainy, stormy all week, and it's supposed to be nice this weekend.
Got to stop and smell the roses.
Yep.
So my slide is missing that I created for this. Technology 101. Just, oh man, I couldn't ask for better. Gosh darn it.
That's all right. I mean, this is a great opportunity and time to talk about how the unexpected happens. And,
right.
Yeah, and when the unexpected happens, how do we deal with it?
Well, actually, I'll tell you something else too. Big uptick. Myself and other realtors I know. I had 3 buyer orientations, brought on 3 new buyers last week.
So, Jennifer, is that happening as a result of just the small little decrease in the prime?
I think that gave people hope, but simultaneously, I think people were also tired of waiting in a way. So I don't think they're going to go back on the shelf. And then I have a new listing coming up. And then I have a listing conversation with someone who has been waiting. We're going to either do it tonight, if I can squeak it in before like commitments come up, or tomorrow morning, and they're ready to buy as well. And so that's what, 5 active transactions that will be coming on within the month.
So my client that I referred over to you, he did reach out and said that you guys had an opportunity to speak, and that he did indicate that he had wished he had found you a little bit earlier. So for all those people out there that are listening to our podcast right now, you've got a fantastic team between getting you ready, getting you the right solutions, and finding the right house right here.
Yep.
So,
and that was in part because the agent he went with, they've listed it high, they've reduced, and so now it's been sitting on the market so long. Do you guys remember I told you I don't lose listings very often, and I lost that one in the spring?
Yeah.
They had listed it at, oh God, what was it? Well over 6. And I had told them that 525 to 550 is where I thought that they should list it.
Right.
A mutual friend reached out and said that they were saying the same thing. They're down to 575, been on the market 6 months now.
Yeah.
Well, this is a recurring theme. Jennifer tells us a story. Unfortunately, the unfortunate part is they often don't come back to let her have the listing. The fortunate part is it shows her professionalism. It qualifies what she's been telling us on these podcasts. I personally know the one she's talking about. When you talk about the difference between what she said it could have sold for and what it's listed for now, she'll probably tell you, Jennifer, tell me if I'm right or wrong. Once you start this downward spiral of lowering the prices and do it in a rapid fire, the market gets that. AI gets that. Other agents see that, and they're just going to lowball because they already see that you're willing to take less and have dropped it. So I hate that for the Jennifer that she doesn't get the transaction. I hate it for the seller because they didn't listen, but I love it for Jennifer because it qualifies what she's saying. And people are watching these things. Jennifer's one of the top.
One of our things in the as being a realtor, and I've told you the difference between a real estate agent and a realtor. National Association of Realtors, we have a code of ethics that we are held to. That's probably going to be changing up. You're going to probably see a lot of realtors becoming real estate agents. I have the same code of ethics, so it doesn't really matter anyway. But one of the things that's in our code of ethics is we're not going to conflate prices. And I see it all the time. People are like, okay, Mr. Seller, we'll try that, Mrs. Seller, to get your listing. Because they know that as soon as it's inked, they can reduce it. And no other agent is allowed to talk to that client once it's inked, unless the client reaches out to them and says, what would you do different? We're allowed to answer some of those questions. We're not allowed to get behind the sign and have other interference, which I understand. I wouldn't want someone coming in and telling my clients, oh, do this, that, and the other, especially if it's what I've been trying to tell them. But that's why feedback is really important as well. I did 7 pre-showings last week, and I gave very honest feedback. Like, this house needs paint. This house needs flooring. This house needs flooring and paint. This house has been listed for 3 months, and now the cobwebs are taking over. You kind of need to fix these things up. Lance, I know you go through that with loans. Like, don't go doing this, that, and the other. And we're supposed to be talking and focusing on you. So do you want to share with us about some of the loan things and process?
Before we jump into that,
yeah,
because this is really important for what you guys are talking about. We need to get to the underlying issue as to why they are pricing these things so high. I almost can guarantee you that it's the silver bullet effect. That is, we need X amount of money from this house in order to pay off our bills because we made horrible behavioral financial decisions. And the only way to get out of our mess is to sell this house for $40,000 above what it's worth. That's right there. It's
in there. But the other thing is, oh, my house is so fantastic, it's worth this. And it's so funny because it's the people who think their house is worth $100,000 over, who, when they're out shopping with me, are like, oh, I'm going to offer $50,000 under on this house. It's not worth it. I'm not offering. I'm like, oh, for God's sake.
That's because they're lowballing stuff, and there's a purpose. There is a reason. There is something inside that couple's mind or that person's mind that's saying, I need X amount of money in order, because they may be relying 1,000% on just the equity of the sale of that home in order to change their financial life. And if that's the case, they're not anywhere near prepared. They need to go back to basic.
Well, some of my people have things paid off, though. I think really what it is in a nutshell is an unrealistic view of money.
Yeah.
Which both of these conversations can have, because I have had people who have had their house paid off and I've maintenance, so I'm not doing this. And I put a new HVAC on mine and this one doesn't have that. So why would I do that? Because that's maintenance. That's not equity.
They have an unrealistic, and sorry, Lance, but I do think that I call it the silver bullet effect. I need X amount of money in order to pay off my debt.
Yeah.
And start over. And they don't learn. Look, it goes back to what I said last week. When you bring something in to alleviate the stress, you lose the opportunity to grow.
Mm-hmm.
Yeah, you're trading one thing for the other.
Yeah,
I will say, I want to talk a little bit about what's happened the last 2 weeks in my world. Jennifer's got listings. Jennifer's got buyers. I have the biggest pipeline I've had. I'll close in October, the most I've closed in 2 years. But it's all was one purchase. It was one of Jennifer's clients they're going to move on to another house.
I think we're offering on Sunday on something else, so don't worry.
Outstanding. Mostly refis. About 2 weeks ago, about 3 weeks ago, there started to be some murmurings. Oh, the Fed's going to finally lower rates. There was a board of governors meeting with the Fed. A little snippet got out, and we started to see a behavioral thing in the markets. We talk about people behavior, Mark. I've been watching market behavior. In the old days, when I started in this career 25 years ago, you could watch the bond market. Things happen slower. You didn't have a just-in-time inventory of money as well. You could say, okay, well, this happened with the bonds. There's a direct correlation. This is what interest rates are going to do. We'll probably see that in the next few days or weeks. Then we got to this real-time world thing where everything just goes helter-skelter, out of control. The last 2 years, when we've seen it hasn't been 2 years, the last year, this started last September, when the Fed starts talking about lowering interest rates, we've seen this behavior where the market reacts based on some sort of intelligence that's happened, and interest rates prior to the Fed making the announcement drop drastically. And that's exactly what happened about 3 weeks ago. I mean, drop drastically. I've got a bunch of loans locked at 5.5% with no cost to the borrower. So no discount, no points, no origination. And you can imagine what that helps for people that have 7.5 or a 6.75, or even a 6.5 over the last couple of years. So they jumped on that. Had a lot of people I had conversations with, Mark and Jennifer, that said, you know what? That's awesome that it's dropping. The Fed's going to drop it. They're saying in about 8 days, they're going to drop. I'm going to hold out. I'm going to wait because it's going to get lower. And I said to them, let's talk about what it's doing for you right now. And this is one of the fun things, Jennifer, about being a broker now, is that I can lock someone into an interest rate. Jennifer, let's take that rate. It's helping you right now. It's saving you $250. But Lance, I want to wait and have it save me $325. Well, let's not bet against it. Unlike in retail, I can lock Jennifer if she's my client with an investor. And if rates go down, I can simply just go with another investor. I'll switch to the other investor and take the lower interest rate and protect them against it rising. But I'll bet you I had 10 or 15 people over the last 3 weeks. They're like, I'm just going to wait. Well, guess what happened? Even before the Fed made that announcement, about 3 days before, we saw interest rates start to take off. And now, guess what? It's not crazy again. They're in the mid sixes again, low to mid sixes. That's a hell of a shift. And so a lot of people have been left on the outside. I'm thankful. I count my blessings that I'm able to refinance people, purchases. The rates are still, for me, being a broker now, are still much better than being in the retail world, particularly in cost.
Yeah, this is not a don't buy conversation.
Right.
This is just to have yourself ready.
Absolutely. And I wanted to talk to what brought this up. Thank you for Jennifer for riding the ship on that. Is that I haven't seen a lot of purchases to talk to and answer what Mark's saying, but I believe it's coming. I personally believe in it. And in the refis I see that people have taken on a lot more debt over the last couple of years. It makes sense. Things are more expensive. I'm not saying it makes sense. That's what you should do, but that's what I'm seeing. People are taking on a lot more debt, and that debt is not at 6% or 6.5%. You hear us talk about this, everybody watching and listening. It's at 29%. That's the average interest rate. And so I think, Jennifer, you and I are going to see this in some of our buyers in the near future. I think some of the things Mark is talking about with not Jennifer's clients, but sellers at all are like, I got to pay back all this debt. And I think that probably is playing into it. But the good realtors, the Jennifers in the world, are going to say, hey, hold your horses. This isn't about your personal debt. This is about what the market will bear. And that ultimately is
It's one of my slides. That's one of my slides. Your house is where someone's going to pay for it, not what you need for it, not what you want for it, not what the internet says, not what your neighbor says.
Well, and to confirm what Lance just said, I just looked up, and as of Q2 2025, total U.S. household debt stood at $18.39 trillion. It's not going down. Debt is not going down. Debt is continuing to rise. And that includes mortgages, credit cards, autos, student loans, all consumer debt. So from tracking this back in November of 2024, I believe it was around 17.9 trillion. Then after the first Q1, I think it was around 18 trillion. Now we're up to 18.39 trillion. So debt is not going down. Debt is rising in consumers. We're taking on more and more debt.
When you talk next week about getting out of debt, will you bring a stat that I'm curious about? which is what is the individual average amount of debt that an American, like if the average American income is, which I don't know, I'm going to pull round history major math, 75,000. What's the average amount of debt that the average household carries? Like, what's the proportion?
Yeah, I'll definitely do that.
More interestingly, too, what's the proportion that the average income carries? What's the proportion that a high average income carries? And what's the income that a lower income carries?
Yeah,
I think that'd be really interesting.
Yeah, I'll find that.
Sounds like history math major there is asking for a bell curve. So I'm looking forward to seeing that. All right, let me go ahead and talk what I was going to talk about this morning, which is different types of loans. So I actually was able to get my technology to work with me for a second, and I'll be able to pull something up. So
yeah, is your background live? It looks like your flag's moving periodically. It's
no, it's not. It's not.
It's a pretty sunrise.
Yeah, I'm stuck in that sunrise. So can y'all see my presentation here?
Yes.
Yes.
Okay, very good. So I'm going to just do a loan program comparison. So when people go to buy a house, there's several different ways they can go about it. They've heard about these conventional, FHA, USDA. I'm going to see if I can go just a full presentation on this. How about that? Very good. Full screen, guys?
Yeah, but change the logo in the upper right hand for yours.
Okay, I'll do that. All right. So this is a loan program comparison. So conventional, FHA, USDA, VA, and jumbo. Those are 5 ways that people can finance to buy their home. There's another way. It's called non-QM, and I'll talk about that in a minute. So let's just talk through some of these throughs real quick. So these are different loan options for people buying a home. With new home buyers, I'll sit down and show them this slide. I know Jennifer talks a little bit about some of the financing options are available and probably points them to me to go over this with people. Conventional is a fixed. There's different ways you can get your interest rate, fixed and adjustable rate options. The highlights of a conventional loan is they sometimes have a lower interest rate than other products. They have fewer penalties and fees. They're good for a second home purchase option, and they're good for investment properties. So if you want to use conventional, it's best that you typically have good credit and a larger down payment. So typically you won't see a first-time home buyer using this product. So when I say they have fewer penalties and fees, I'll talk about that after I go through all 5 of these and what that might mean for you. So again, conventional, typically good credit, large amount for down payment. You may have heard in the past that, oh, you want to have 20% down. Not exactly true. You can go as little as 3% down and get a conventional loan. All right, the next type of loan is FHA. That's down through the Federal Housing Administration. Those are loans that are written by brokers like myself, but they are insured and overseen by the Federal Housing Administration. And when we write a loan for this, they have to be underwritten to these stringent guidelines that they can be fixed or adjustable rate options. They have very low down payment options, 3.5%, or if you partner with a bond program or maybe a first-time home buyer program, you might hear people say that it's a 0% down option. That's true, but it's not. The FHA loan portion still is going to be 3.5% down, but there's going to be money coming from someplace else to help with that. So the FHA has flexible income and credit requirements, and they're best if you're a first-time home buyer or have a limited amount of funds for down payment. We'll come back and talk about FHA a little bit more in a second. Then there's USDA. This United States Department of Agriculture helps offer homes that are in USDA designated rural areas. In working with Jennifer for the last 10 years, I'll often tell you that she educates me about things. And one of the things she educated me about was that it doesn't necessarily have to be out in the country. When you're thinking about USDA, that doesn't mean that you've got to be driving, you can't see houses, and there's poles, power lines and rolling fields. Nope, not exactly. You can actually have USDA designated areas that are maybe in town. Here in Middle Tennessee, there are parts of Spring Hill and Columbia, Tennessee that look like they're in town, but they're USDA designated. And what does that mean? For USDA loans, it's a fixed rate option. They don't offer ARMs. We'll talk about ARMs in a second. There's no down payment required. They have very low credit score requirements, and they're flexible with their underwriting requirements as well. So this is best used for purchasing a home in the USDA designated rural area. So how would
let
you
me
find?
caveat something there really quick. So Spring Hill was USDA eligible until 2016. The population density is what threw it out. And Columbia is not, but the rest of Murray County, aside from Columbia and Spring Hill, is, and like all of Marshall County is, which is, people would not feel that that is really rural in a lot of areas. And there are areas of Williamson County that are still USDA eligible. Has to do a lot with population density. Sorry to jump in.
You're fine. And I would clarify that to add on to that, in me saying that what people think is Spring Hill and what people think is Columbia, some of those areas fall under the USDA. I mean,
Yeah.
You know how there's other little burgs and towns around
Mount
it.
Juliet was, it might not be today, but it was very recently still.
So how you would find out about that is you'd contact Jennifer or myself, and we would break that down for it. By the way, USDA has some income requirements. You can't make over a certain amount of money to use that product. So, it says on here that it's flexible credit underwriting. They also are stringent in the same way. Let's talk about option number 4, VA. That's the Veterans Administration. They have fixed and adjustable rate options, 0 to no down payment options, low income and credit requirements, and most importantly, no mortgage insurance. So for mortgage insurance is required whenever you have a loan that is over 80% of the value of the home you're buying. So if you're buying a $100,000 home, 80% would be $80,000. So if you need to borrow over 80% and you're not using a VA loan, you would be required to have mortgage insurance. Asterisk, asterisk, ask me later. There are ways to avoid mortgage insurance. Actually, not avoid it, but to buy your way out of it, meaning that you can prepay for it or pay a small fee that the mortgage insurance goes away and you don't have it. A lot of people don't know about that, and I probably could talk about that in a future episode. Finally, jumbo loans. These are for loans that are above the limit for conforming. I saw recently this week that the new conforming limit, I believe, in Middle Tennessee is $879,000. That's what it's going to be for 2026. Gosh, when I started in this industry, I think the conforming limit was like $218,000 or something like that. So it makes me feel old. Huh. So that's for borrowing above. If you need to go above that limit, it's considered a jumbo loan. And jumbo loans, they do have fixed rate options. You can have as low as a 640 credit score, and they're available for first time and repeat borrowers. And as it says on the right, it's best if you're looking for a house that's above the conforming limit.
Hey, Lance, I accidentally changed the screen. I was going to say that's crazy, but I removed myself from the stage and then I added myself back, and now I've changed the thing because tech genius. I apologize.
You're fine. How about now?
Yeah, that's good. I apologize.
You're fine. All right, let's see if I can blast down here and talk about some things that we'll want to talk about. We're talking about FHA, minimum down payment of 3.5%. The maximum mortgage amount is going to depend on the area. So I was talking about that conforming limit a second ago, up around the high 800s. Some areas are not up in that. They're a little bit lower based on your geography and your zip code. So some limits are going to be maybe down in the 300,000 and 400,000 if they're a very rural county. Qualifying ratios, PMI. With FHA, you do have to have mortgage insurance on every loan. It wouldn't matter if you put down 50%, you're going to have mortgage insurance and you're going to prepay it. It's typically 1.7, not typically, it's always 1.75% of the loan amount. So for every $100,000, $1,750 is the fee to play ball with FHA. Now, as a borrower, you don't have to bring that to the table. You can bring it to the table if you want, but most of it's financed into the loan. FHA allows that to be financed into the loan. Mark, I see your ears perking up. Imagine if it's a $500,000 loan. If you had a $500,000 loan, which is totally allowable up for FHA in Davidson or Williamson County, 500,000 times 0.0175, they would be financing in $8,750 of prepaid mortgage insurance. But guess what? FHA rates are typically, lately anyway, about a half a point, sometimes greater, lower than the conventional rates. So sometimes that's a good trade-off, and sometimes if people don't have down payment money, remember what I said, with as little as 3.5% down, you can go FHA.
Well, and Lance, let me jump in. This is the reason why anyone listening right now, this is the reason why I encourage you to reach out to Lance and Jennifer. The reason why is because what you just heard was, okay, now we have a goal. in my world, 8750. How are we going to get there? How quickly can we get there? And what is it going to take for us to get there? We save 8750 or whatever that amount was. I think it was 8750, but as a goal, in order for you to save for however long you're going to be in that house. I mean, you're improving your financial foundation. And so these are all the kinds of discussions that you will only get through a person like Lance.
Thank you, Mark, for putting that in. One of the things I like to talk about when you were talking about the different kinds of mortgages, when you call me, I can walk people through what's going to be best for them. One that I left off a second ago was the non-QM loan. Non-QM loans are loans that don't meet the requirements of the federal government for oversight. So a non-QM loan would be something like a stated income loan or a bank statement loan or something that's really outside the box. Now, they're not going to do that at 100% financing or 95 or 90. They'll typically be about 75, 80%. The buyer's going to have some skin in the game. But
Yeah,
there's private. Absolutely. There's private equity or private banks out there that will make the loan based on they'll underwrite and review the person. For Jennifer, she has a product. She went to a local bank. They trust her. They looked at what she's done historically, income wise, et cetera. And so they've done, and the rates aren't crazy. In the old days, they were like 10, 13, 15%. They're much lower than that. They're just a little bit over what regular rates are right now.
And let's talk about what I should have done ahead of time, since you're talking about do's and don'ts, that I could have gotten a qualifying with a little better rate, which was when my son bought his house and he was completely able to do it on his own, except he was 2 points shy of his credit score because he only had a car loan. So I co-signed for him, but he's done everything on his own. But he was paying for the bank account that we had set up for him when he was 16 that I was on. So when I went to get my home, there was no way to prove that he was the one making those payments.
Right.
So that was something I had no clue about. I mean, and then we're like, okay, so let's set him up on his own bank account so that when I want to refi, when these rates, I'm looking at doing an app now so that when the rates tick down, I can get a refi on it. Very appreciative to my bank for doing that. But it's also a 5-year. It's amortized over 30, but it's a 5-year balloon, which means in 5 years from when I took it out, I have to have it paid off by either selling the house, paying it off, or refinancing it.
Right. So that's a great example. What Jennifer's doing is a great example of just how there's different mortgage products out there and there's different strokes for different folks. So one of the things I learned about 15 years ago in my career was never say never. There's always a way to get something done. So if someone's like, there's no way you're going to get that done, keep digging. There's a way to get it done. And Jennifer is one of those people that you're not going to tell she's not going to get it done. So she's going to dig, fight, scratch, and get through it.
Don't tell me no.
So speaking of no, I want to talk about some do's and don'ts about applying for a mortgage, and then we'll open it up for some discussion. Some do's, keep originals or be able to access your employers or bank websites for places you've worked in the past, or keep your pay stubs. So if you've worked someplace for 3 or 4 years and you just changed jobs or maybe you changed, keep that information around, keep it in a safe, make sure you have access, because when you apply for a loan, I'm going to be asking for things like that. I've got a young couple right now that Jennifer, you may be helping with pretty soon. They're friends of my daughter and her husband. They want to buy a house, and they don't, like most people, they don't understand about how income is figured for a home loan. Most, young's probably a word we're not even allowed to use. So most, what's the word I can say, Jennifer, instead of young? People that have not bought a home before, that their experience
with borrowers, whatever.
What is it?
First-time borrowers, because they can be
first. Absolutely, first time. Well, what I'm going to say isn't typically sometimes for a first-time home buyer, the only experience they've had with buying something is buying a car. Buying a car is much different than buying a house. When you go and buy a car, you go into the dealership. Guys, don't do this, by the way. Don't let them shop your credit. Get yourself a pre-approval from your bank or local. Because when they're there, they're going to shop you to 27, 30 different people. I'm not making this up. That will affect your credit in the future. Anyway, buying a car, you walk in
as cash when you have your pre-approval from your bank.
Absolutely. When you're buying a car, it's a very easy process. They pull up something like, oh, this is what your FICO score is. This is what we're going to use, and you leave with a car. Well, what you need to realize, and this is a little speech on my behalf, is whatever you're buying is probably worth half of what you're paying for, even if it's brand new. And if you don't make payments on that vehicle, they will come and take it. It's a simple fact. You will come out of if you don't pay your payments for 6 months, you will come out some morning and your car will not be there. And you're still going to owe the bank this money for the rest of your life. And they're going to sell it for pennies on the dollar. And you're still going to owe the full amount plus something else, I promise you. A house is much different. They're going to look when making a mortgage, we're going to look at your income and we're going to dive in, because if we're going to lend you 400, 300, 200, $1 million, there's got to be a way to repay that. Now, some of you are saying, oh, well, you just take the house. You leave the house and you just sell it and get it back. Well, it's not that easy. A lot of times when people stop paying for a home or leave a home, they leave the house in not too good a condition when they leave. We saw that a lot after in 2008. So why do I want people to keep track of their pay stubs and et cetera from the past? Because sometimes we need to look at that couple I'm talking about. The young lady is she does hair and makeup, and she's paid with a W-2. So like, well, here's my W-2 that can show you what my income is. Not exactly. What did Lee Corso used to say on ESPN? Not so fast, my friend. A W-2 is for people that are paid via W-2. It's going to show hourly income and it's going to show commissionable income. So we've got to be able to break that down. We've got to be able to build a 2-year history of how someone makes their income. So if their hourly pay is one thing and their commission is another, we've got to break those down separately to make sure that the person has the propensity to continue to do that. And for a 2-year history, if you've changed jobs, we might need or request of you to pull that very last pay stub of the year you worked someplace, because that's going to show us how much hourly income you had, how much commissionable income. And unfortunately, when you become a little bit older, some people borrow against their 401ks and things like that. And that shows up on that statement, because we've got to take that into consideration in making a loan. Anyway, helpful do's and don'ts. Have all that documentation. Provide your earnest money deposit from your own personal bank account or acceptable gift funds, not from under your mattress or a friend lending it to you. Notify your loan officer if you plan to receive gift funds for closing. You can get that you can actually get gifts of pretty sizable amounts for conventional FHA and USDA, even VA. Notify your loan officer anytime there's an employment change, such as a raise, a promotion, or transfer, or if you quit. That probably is going to greatly affect your approval. And then be aware that a new credit report is always pulled right prior to closing. It's pulled about 10 days prior. And that's to make sure that the borrower hasn't gone out and done something that might jeopardize their approval.
And I'll tell you what, Lance, when I do my buyer's orientation, I talk about that income a lot. And I say, before you change, you talk to your loan officer. Because we've had situations where someone's and they're like, well, why? If it's a promotion, I'm at the same company. I said, you're making $75,000 now on a W-2. It's not a bonus situation. They're going to give you a leadership role. You are going to make now $50,000 base and another $50,000 bonus. So to them, it's a $25,000 net. But to you, it's a $25,000 drop because they haven't had that bonus for 2 years. It's not sustained and we don't know if it can happen. So I'm like, just pause before you do something.
And let's just talk about it. If they'll just talk about it, then that would be good if we would just talk about it. All right, let's see if we can go back to our screen. Is the screen showing?
No.
All right, we'll go back to it real quick. I'm sorry. Oh gosh, what did I do?
While you're doing that, we're not going to talk about it today, but I can have my rant about the government-backed mortgages and the appraisals because they all have very similar underwriting.
Well, before you rage, Jennifer, Lance is back.
Go ahead. Say what you're going to say.
Yeah. So one of the things that in my services that I do for my clients is, I'm not just a budget. We're not just developing budgets and stuff like that. We're actually doing a comprehensive financial base and financial literacy. Part of that include, I'm trying to get people to understand the set it and forget it mindset is not necessarily your best course. And the reason why is because it's not that hard. When was the last time that you actually looked at your pay stub? When it logged into your employer and checked it out. So I'll just give you a hint on some of the comprehensive financial literacy, financial base that I work with my clients on. We go through and we pull out W-2s, we pull down pay stubs. I myself have a notebook that I can go back 4 years on my pay stub. It's not that hard. Print it out, put it, do a three hole punch, put it in a notebook, call it 2024. Not hard.
And
I
if
don't know
you're
why.
digital and you don't have a computer, you still have the method to print to a PDF, put it in a file that says pay stubs, and then say 2024, 2023, 2025, all of those. Same thing. You don't have to print if you don't have that ability or desire to have that, but you do need to have them accessible.
Yeah. If internet goes out, how are you going to get your documents?
So funny you just said that, because I just lost my internet. Oh my gosh.
Yeah. I mean, I'm not saying there's a security piece to that too. It's got to be safe, but comprehensive plan means, we need to dive in and actively take action so that you can look at what's been going on over the course of time. I can look back. I'm not saying that we need to all hoard documents in our home. I'm not saying that. But what I am saying is if you're working towards a home, for me, I have sat down and I worked out a checklist of what do I need in order to start the process of purchasing a home. What you guys have brought and your knowledge has brought. What is it that we need to do in order to start that process? Checklist is fantastic.
I've completely lost my connection. Internet has failed but I have a hotspot by me. I'm trying to connect to it. I think this might be a good time to end the call. Technology, I know we're all different places. Right. I'm pretty sure it's
going to do a recap for us. So, first of all, things that we've talked about that are myth busters. You don't need 20% down.
Correct. Mortgage insurance.
You have methods of helping people per the algorithm of the lending magic know how to improve their credit score. If you're within a year of wanting to buy a home, now is the time to talk to you so that you don't do something that inadvertently delays that. There are government loans, there are conforming loans, and there are non-conforming loans. So we have lots of options to get people funded. There's what might work for your best friend might not work for you, but something else will. And those are the basics that we've kind of talked about, right?
Yep.
And the 5 different types of loans: conventional loans, FHA, USDA, VA,
and non-conforming.
Non-conforming, yep. And we talked about the unexpected, how to deal with the unexpected. This we've had 2 examples of unexpected.
Well, ironically, while we were just talking, I had a borrower that Jennifer and I are working with. Just text me and say, "Hey, I've got 2. It's a type of loan against their 401k." And they're like, "Is this going to matter?" It's going to greatly matter.
Live it.
So you couldn't even make this up that just popped up on as a text. So
that's what I'm talking about. They probably have done those in the last little bit.
Yeah.
Because people's finances are really tight, so they're borrowing against 401ks to take care of credit cards and things like that. So when you say, one of my first conversations if they talk to me before Lance is, "Can I buy a home?" I'm like, give me an idea of what your income is, what your debts are. Sounds like you should, yes, let's talk to Lance, or yes, but we may need to get some things in place. They may say, "Oh, I have no credit card debt. I have no car loan. I'm good." Because they forgot
Yeah.
about the 401k loan because it's coming off of their pay cut check. They're not seeing it. They're not looking at it every month. It's just dealt with.
And thanks.
If anyone is out there thinking about right now, thinking I'm going to borrow against my 401k, please reach out to me. Please.
Stop.
Just stop.
Collaborate and listen.
Exactly.
Yeah. All right, guys, we're right at 40 minutes. Actually, yeah, 40 minutes is perfect time to stop. I think it's good. Is my flag
Next
moving?
week, we're talking about getting on a budget and how that works and some of the preliminaries. And then we'll have a special guest. I'll be setting that up probably today so we know what we're doing.
You rock. I'm going to go ahead and end the recording and get this out. Thanks for joining us, everybody. Talk to you soon.
See ya.